Markets rattle as White House confirms U.S. tariffs on China soar to 145% in a dramatic turn of events. The White House has confirmed that total U.S. tariffs on Chinese goods now amount to a staggering 145%, clearing up earlier confusion surrounding President Trump's trade measures. This figure includes the existing 20% tariff imposed at the beginning of the year, alongside a new 125% hike announced just yesterday. The announcement sent shockwaves through financial markets. After Wall Street enjoyed a euphoric rally just a day prior, U.S. stock indices plunged across the board. The Dow dropped 3.4%, the S&P 500 fell 4.2%, and the Nasdaq tumbled 5%, reflecting deepening investor anxiety over the future of U.S.-China trade relations. Despite the chaos in New York, markets in Europe and Asia surged, largely responding to earlier momentum before the full scale of the tariffs became clear. But now, with the dust settling, investors and lawmakers alike are scrambling to understand the strategy, if one exists at all. Confusion in Washington. The situation has been marked by mixed messaging and evident disarray. Initially, President Trump posted on Truth Social that tariffs would rise to 125%. But as the day unfolded, the White House clarified the final figure includes the prior 20%, bringing the total to 145%. The rationale behind the increase? According to the administration, it's a response to China's alleged role in enabling the flow of fentanyl into the USA, justification that has only added to the controversy and confusion. Even within Trump's own circle, clarity is lacking. Jameson Greer, the president's top trade advisor, testified before Congress seemingly unaware of a 90-day pause Trump had just announced, an embarrassing moment that sparked rebukes from lawmakers across both parties. "I still don't know what his total strategy is," said Republican Senator Ron Johnson. Democrat Elissa Slotkin echoed the sentiment, bluntly asking, "I'm just trying to understand what the hell is happening." Wall Street's whiplash. After an historic one-day surge, markets have reversed course. As of today, the S&P 500 is down nearly 6% from its level on April 2nd, when Trump first announced the new tariff package. The earlier rally, fueled by hopes of a potential resolution, has been erased by fresh uncertainty. "Markets hate confusion," noted BBC economic correspondent Andy Verity. "We're not seeing a cancellation of a trade war, just a 90-day postponement. And what's coming still looks like the largest bilateral trade war in decades." Former U.S. Treasury Secretary Janet Yellen added to the drama, suggesting that the recent sell-off in U.S. Treasury bonds, once considered the safest asset in the world, may have been what spooked Trump into declaring the pause. "The bond market is the bedrock of global finance," Verity explained. Undermining confidence in U.S. Treasuries risks not only the dollar's dominance, but the entire perception of America as a stable economic power. China's dilemma. The impact on China could be equally severe. Dr. Zhongyuan Zoe Liu, senior fellow at the Council on Foreign Relations, emphasized the tariffs' likely toll on small and mid-sized Chinese exporters, who are already facing order cancellations and stalled shipments. These businesses represent around 80% of China's exports and most of its employment, she noted. "This is absolutely not what Beijing wants right now." China has long held substantial reserves of U.S. Treasury bonds, over $3 trillion in foreign exchange reserves, largely because treasuries are considered safe, liquid assets. Yet in response to growing tensions, China has gradually reduced its holdings, wary of becoming overexposed. But as Liu warned, any instability in the U.S. bond market will hurt China too. The scale of China's holdings means a sudden sell-off would be self-defeating. Enter the Mar-a-Lago Accord. In an intriguing twist, Liu pointed to a potential strategy behind Trump's erratic tariff policy, what's being dubbed the Mar-a-Lago Accord, an echo of the historic 1985 Plaza Accord. The proposal, named after Trump's Florida estate, seeks to rebalance global trade by devaluing the US dollar, boosting exports, and pressuring allies to pay more for defense. But critics warn the goals are contradictory. You can't simultaneously maintain the dollar's dominance, devalue it for export gains, and run a trade surplus when you've had deficits since the 1970s, Lu said. These objectives simply don't align. The bottom line is markets reel and confusion swirls in Washington. One thing is clear, global trade is entering a dangerous and unpredictable phase. With tariffs at record levels, financial institutions on edge, and the world's two largest economies edging toward confrontation, investors and policymakers are bracing for a volatile ride.